All right, starting here. Remember, we have our two problems. We have the first one we're looking at is a recession. So in a recession, our goal for aggregate demand, we want that to increase. Our policy is expansionary. And our tools, we have the reserve ratio, which we can lower, which makes excess reserves increase.
Wait, what does R stand for?
Reserve ratio. Reserve ratio is the percentage of the money you put in the bank that they cannot loan out. So if you put $1,000 in the bank and it's 10%, they have to keep $100. Okay, the excess reserves would be the $900 that they can loan out and start the multiple deposit expansion process. Okay, and that ends up making our money supply go up. Also, we want to buy bonds, which makes big bucks, which makes the money supply go up, correct? Both of those are going to lower the interest rate. And if we're not dealing with money directly, the borrowing of money, we have the discount rate, the Fed funds rate can be lowered. That's right. Okay, those are the rates. Fed funds rate, FFR, is the rate at which banks borrow from each other when they don't have enough money to cover deposits or loans. And if no banks have any money, they call the Federal Reserve Bank, and they borrow at DR, the discount rate. Remember, the Federal Reserve cannot set loan or set interest rates. They can target them by altering the discount rate and the Fed funds rate. Okay, and then whenever we have more money available and low interest rates, bond prices will go up. Bond price and interest rate are inversely related, so you pay more for a more secure bond, but it does give you lower interest, which is a trade-off. Okay, so over here, C and I, that's our consumption and our investment. So at low interest rates, people are going to be incentivized to borrow. So they'll borrow money and go buy a car, go buy a house. They'll invest in capital goods, so that will go up. And this right here is not a bracket, but rather something linking it. So this right here is showing consumption and investment are going up, and what is aggregate demand going to do? It's going to go up. So our goal was to make it go up. This is how we made aggregate demand go up. So it did work. Now this K right here is capital. These things are our growth items. So now if we're investing in our businesses, our supply side, then we will have economic growth with more capital goods. Okay. Later we'll look at foreign exchange, where the real interest rate attracts people to foreign markets, and then that affects the exchange rate and net exports. But right now, let's look at the rest of our scenario. So aggregate demand goes up. I know GDP and price level will go up. Okay. Price level is tied to inflation. That's what this little bracket is right here. So unfortunately, we do get GDP to go up, but what it causes when businesses compete for resources is inflation. Now, unemployment in SR. SR is short run. So unemployment is going to decrease, and that was the goal, because a recession is when we have unemployment. Now, our expected inflation rate is what that one is. This is unemployment in the long run. These are our nominal interest rate, our real interest rate in the long run, and then our side effects. So, what we can look at from there, let's see if I can do this, is our expected inflation rate, our unemployment in the long run. So unemployment in the long run, that is going to put us at the natural rate of unemployment. So the natural rate of unemployment, what did we get rid of during a recession? What kind of unemployment? Cyclical. Because in a recession, the business cycle is down, isn't it? But I guarantee, do you think today someone got upset and quit their job? That's frictional, right? Out of the millions of people in the United States, somebody quit their job, and no policy will fix that, will it? Okay, and there are also people whose job skills declined, and now they're unemployed. Okay, so that no policy can fix that either. Okay, so what we did was we got back in the long run to the natural rate, because frictional and structural will exist. Our policies are set to get rid of any cyclical unemployment. People who lost their jobs because the economy is down. So interest rates, nominal and real interest rates in the long run, they're going to remain neutral, because we don't know what they're going to do. It's NEUTR, And I ran out of room. Neutral. Okay. Now, unfortunately, what is our side effect of reducing unemployment? What do we cause? We cause inflation. Okay. It's like that game whack-a-mole. You knock down unemployment, here comes inflation. You knock down inflation, you cause unemployment. Correct. And so for those expansionary policies, we do have our side effects. Now, what can you now here's the other thing. This is expected inflation. So if you know that we have a policy that's going to cause economic success, so you got a plan for prices to go up, don't you? So my inflationary expectations, so this is inflationary expectations. Those are going to go up. Businesses have to plan for this. If you get a job in the finance world, you'll have to look at a 30-year mortgage, what you expect inflation to be, and plan for it. So our inflationary expectations will go up. We'll just think that prices will go up with that policy.